The broadcast is now starting. All attendees are in listen-only mode.
Markets are shooting higher. Certainly, they haven't slowed down since the Brexit news, which caused a minor correction in the majors. They've been basically at or near new highs, and the S&P has been in a very tight. That was the tightest trading range it had since 1970. That trading range had occurred over the last was for about I'd say 12-day trading period, and now we've got the Bank of England lowering rates for the first time. I think to 25 basis points from 50 basis points for the first time in 7 years. It's not that big a surprise, since they had indicated they would be very liquidity friendly, especially in light of Brexit and all the uncertainties that it introduces. So you got the UK, the FTSE, I think, is up like a 1.5%, and other European bourses are up in sympathy with all of that. And the thing about the environment we're in, I mean, it is quite unprecedented. We've had situations where world governments dug a debt hole so deep, and whenever they have done this, they never pay the debt back. It never gets paid back. What ends up happening inevitably is that you have a changing of the guard. In other words, fiat currencies have a limited lifespan. So right now, fiat could be the dollar. That's the tallest standing midget. You also got the euro and the pound. But there will be a changing of the guard of these currencies probably within the next 5 to 10 years. Could even happen sooner. But in the meantime, all these central banks are going to continue to print money, and they're going to continue to dig a deeper and deeper hole for themselves. And Bill Gross, who used to run the world's largest bond fund, now he's with Janus. He writes his monthly reports, and he's been very morose about where things are headed. And he's right on every count. He talks about how the structure, this sort of financial structure, cannot support these low or negative interest rates. It's damaging pension funds, to insurance companies, to banks, and so forth. So the structure is slowly eroding and ultimately on the way to major collapse. And he's not the only highly respected individual to say these sorts of things, and you've got Jimmy Rogers been talking about this for quite some time. The only issue that I have with any of what they're talking about is that the central banks continue to print. They can continue to do this for many years. By many years, I mean, we could still be in this debt swamp 3 years from now, with central banks saying what they say, with the Federal Reserve jawboning about how rates have to go higher because the economy's starting to look better, but then ultimately reversing course and doing nothing. Or actually, at some point, perhaps going into negative interest rates and joining the European countries as well as Japan. We've got, of course, the German bond, 10-year bond hit negative rates for the first time in its history. And Janet Yellen has said that she's not opposed to negative rates. She said that in 2010, and she also said that more recently, or more recently implied that rates could go lower if necessary. So it's a very interesting time to be around as investors. I think that obviously the trend is your friend, and we continue to see more and more evidence of dovishness and more quantitative easing coming through. So the capital has to find a way, a home, and it's finding the home in U.S. stocks, which are the tallest standing midget when it comes to stock markets, and it will find a home in bonds, U.S. treasuries, and hard assets like real estate and gold. And it's interesting that Satoshi Nakamoto, who created Bitcoin in 2008, as in response to the financial explosion the world witnessed in 2008, and this is a tool that he feels is a great answer to governments that print money to fund their wars and all this this damage that has occurred cycle after cycle. Basically, it reduces, it takes the central bank structure out of the equation. And this is something, it's a technology that's never existed in the history of humanity, and it's really taking hold. And not just crypto technologies like Bitcoin, but there's other emerging technologies that are also starting to prove out. The total market cap of crypto right now is about 10 billion, but that could easily see a day where it's 10 trillion or even more, based on what the potential behind it. So at any rate, we're here to stay the course. Both the timing models remain on signals that suggest the markets are going to go higher. Of course, the volatility model is much quicker. It may spot a moment where it can take some gains, but right now things are looking like more blue sky ahead. And we've had a number of stocks that have become actionable over the last few weeks, and they seem to be doing okay. I went through a bunch of these names last webinar. So at any rate, I will go ahead at this point and turn it over to Gil.
Well, I think you can view things as usual in concrete terms, and I think it all boils down to the individual stocks. You can see the NASDAQ is far and away the leading index. You can see the S&P 500 here relative to the NASDAQ is flatlining and has been for pretty much the last month. Maybe a little less than that, say the last 3.5 weeks. And meanwhile, the NASDAQ has been streaking higher. So a lot of people have been talking about the NASDAQ lagging the Dow and the S&P because they've broken out to all-time highs. But the reality is, since the lows of late June, the NASDAQ has been outperforming. But that performance has been very narrow and mostly seen in the NASDAQ 100 stocks, okay? And of course, that's been driven by nice moves in Apple, Google, Amazon, Microsoft, I think, had a nice move after earnings, gapped up. So that's really what's been driving that. So in reality, you've got this narrow rally, and it's being driven mostly by big cap NASDAQ stocks. Forget the fundamentals. You know, Microsoft's not really growing at a big clip. Google isn't growing at a big clip. Amazon shows some strong fundamentals, and it's actually holding along the 10-day. This actually looks pretty good to me. But it's being driven by fewer and fewer names, so it's not clear to me whether that's necessarily a problem. If you go back, however, to last year, let's go back to last July. You can see last July on the NASDAQ, let's go to the NASDAQ here. Swing back to July of last year. You had an undercut of the prior lows in here. Let me get my pen up here. So you see where you undercut these lows in here. There's a series of lows that were undercut here, and then the market took off and ran to new highs and actually made an all-time high. And that was a lot of fanfare around that, and everybody was bullish and everything was wonderful. But then the market rolled over and broke down severely. And a lot of this was being driven by the NDX at the time also. So the similar condition there in terms of the very light or very narrow leadership. But also, if we look at the NYA composite, and New York Stock Exchange composite index, rather, the NYA, we can see that before and as the NASDAQ was making new highs here in July, it was actually bumping into its 50-day moving average, and it actually already topped in May. So the broader market was already topping, and the NASDAQ was making new highs. So there's a sign of some chinks in the armor, so to speak. And once you started seeing leading stocks busting, so for example, back then we saw Apple. We'll go back to July of last year. We saw Apple trying to break out in the middle of July, and it failed. And its failure was coincident with the NASDAQ failure in July of last year as well. So what we know, if we're trying to compare as best we can apples to apples, and consider that the current divergence and narrowness in the NASDAQ 100 leading the rest of the market as everything else kind of flatlines over the last 3-4 weeks, then what were the signs that told us we were breaking down at this time? And mostly these leading stocks, and a lot of these big leading stocks that were looking strong, like Apple at the time, broke down. Let's look at Facebook. Well, let's see, that's my index here. Let's go back over here and look at Facebook, for example. And last July, I actually haven't looked at this yet. It was also breaking out, and then it eventually failed, but its failure came later on as the market just came completely apart. So you're looking for some signs in some of these that they're breaking down. We saw, for example, look at Skyworks Solutions was one that broke. And you can go back and you'll see just a number of stocks that blew apart and were actually diverging at the time that the NASDAQ was making an all-time high. So I think that's something we want to keep an eye out for right now from a concrete perspective. I don't think you need to necessarily get bearish and run for the hills because Bill Gross is telling you. But I don't think Bill Gross is the type of guy who talks his book as much as other guys. Like, you know, Jim Cramer, for example, is a permabull because he only knows how to be long all the time. So people who are more flexible, I would give more credence to. I think Gross is a little more flexible, but you know, he could be right, he could be wrong. I can see where he's seeing some signs, both systemically and in terms of the market being extended to the upside and allegedly overvalued, which is what you're hearing a lot of these days. I can understand how you might come to the conclusion that we're set up for a possible correction. But as investors, as traders, we can only operate on the concrete real-time evidence. So that's what I'm watching for. But I got to tell you, I'm watching it very closely. But it doesn't change my approach to the market. I'm ready to go short at any point, and I'll be long and short at the same time if I think that is feasible. But my general approach has remained to be selling into extended strength and then looking to buy on weakness with the idea that if you're buying a stock as it's pulling in, let's use an example of one that I've liked. But you know, here's Splunk, and I'll buy it along the 20-day, and it runs up like this. I'll sell into that. It comes back in. I'll look at buying it. Now we're back into the 20-day line today. But you know, the idea would be buying it along the 20-day here with the idea that it's not going to go below the 50-day, and preferably would hold tight along the 20-day moving average. So you know, that limits your risk. And this is a pocket pivot breakout here. But of course, you also have to pay attention to what the weekly charts are showing you. In this case, you do have a very big V-shaped type of pod formation. You're up around areas of resistance from the left side of the pattern over here. So, you know, you're at a point where this could fail. So, you know, I'd be open to going short Splunk under the right conditions. Look at Facebook right now. Now, I think Facebook, it comes down to the 10-day yesterday. With volume drawing up, you buy it. I mean, I bought it yesterday, but I'm selling into this move. Mainly because I'm not all that convinced that it's out of the woods yet. I think it may sit along the 10-day for a while, possibly even test the 20-day moving average. They received a notice of, I forget what it was, basically a notice from the IRS saying that we don't think you did your taxes right and you may owe us $3 to $5 billion, which is about, if you figure that their revenues in the last quarter were 6.44 million, or billion rather, that's a pretty good chunk. So maybe half a quarter to, you know, 4/5 of a quarter's worth of revenues get swallowed up there. I don't know how bad that is for the company in the long run, but it could just set up a buying opportunity. We don't know for sure. And so far, you might even argue that it has, because you're coming into the top of this base here. And I think Facebook's a big leader we want to keep an eye on. If you saw failure through the 20-day line, say here, and in big volume, you saw volume spiking, then that could be an issue and tell you that the stock is in a late-stage base failure. It's hard to see that coming because they seem to be hitting on all cylinders, but we also have to remember that stocks will and do top when the news seems to be most positive. All we know is we're sitting right on top. If this is your breakout point here, you're sitting right on top of it. The 20-day line here more or less coincides with it, so it could drift in a little bit more and then maybe try to come out, or it could blow apart. And so, you know, I look at stocks both ways. I'm not into this, as I was tweeting earlier, the dualism of the bull and the bear. I don't really think that is useful in this sort of market. I just watch the stocks and let them tell me what to do. So in this case, Facebook coming into the 10-day, that's a reasonable buy entry point, with the idea that it's either going to hold the 20-day at best or the 10-day, depending on how you want to handle it. And you'd be making a little bit over $1 right now if you went long yesterday. But the stock was trading above 124 just a little while ago, and we'll see where it goes from here. I find that the best moves seem to occur, if you want the most thrust, you've really got to be looking at what stocks do after earnings. And one stock that I was pretty successful with last week was Mobileye, which undercut this low, and I think we talked about it. And when it undercut the low, you got a 620 buy signal on the intraday. It runs up to the 10-day, so you got to sell into that because that's more than a 10% move. It's closer to a 15% move off the absolute lows here. Is that right? Yeah, make it a 10% plus move. And then you roll back over. Now you're sort of hovering below the 20-day line here. This could turn into a short. I'm not going to sit here and say, oh, you got to be long this thing, because if we look at this, it formed a pod last year, and you guys might remember this if you go back to the webinars. I pretty much nailed this thing. Here's the big pod and handle, tried to break out here, and it failed. And as soon as it started to fail, it was right after the breakout. You know, and IBD was talking about this being a new leader breaking out, blah, 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 because, of course, the NASDAQ was breaking out to all-time highs. So IBD, being a momentum newspaper, has to go that way. And, of course, that's wrong because they're not looking at the bigger picture. Basically, the fact that this thing comes straight up the right side of this pod, punch bowl of death. Here's the, you know, there it is. Here's the ladle for your punch. So, and you could have a cup over here, and you can drink the punch from the punch bowl of death. I don't know if there's waves in punch bowls, but mine has them. And it's green punch, by the way. So, you know, there's your punch bowl of death, and it fails here, and this thing just blew apart. So you're forming a second sort of punch bowl formation, and I wouldn't say that it's necessarily going to lead to imminent failure, but it's something to watch for, because this could fail, and if it did, it would tell you that we've got some issues. So, you know, you can see with Facebook possibly failing, that would tell you what's happening. I mean, I'd watch Apple, which I thought was a pretty good trade, off of the BGU and the Bible gap up in the 200-day line. It's up a couple of percent from there, trying to edge higher, but the volume's running out. So what I would watch here is you break the 20-day line, and or I'm sorry, the 200-day line on volume, and this thing's probably rolling over and becomes a short again. So if we look at Google, or Alphabet rather, I still haven't really made that adjustment, Dr. K, calling it Alphabet. It almost seems like it's a cheesy name to take them, but whatever. But I think it was they were trying to make it sound like it's a bet on alpha, on the growth portions of their business. But you, Dr. K, you think that Google is sort of a stock when it comes to fundamentals, right?
Well, I think that its heyday is over. You know, we've seen this happen with many names. You know, Microsoft back, you know, the first few years, it was huge. You know, it's a sprinter. And then these companies get older. You know, when you're in your 20s, you're at your physical peak. You know, and then by the time you get into your 50s, you have all the experience, but you can no longer outrun someone who's in their 20s. And that's kind of how I see Google. But I think Google's got, you know, some of the best technologies that they're rolling out. You know, they're an incredible company, and you know, they do, I think, have some killer apps on the way. It's just that their sheer size makes it, I think, more difficult for them to have big runs. But that said, I think it is, you know, if you wanted to do a long-term investment in a tech company, I think this would be my choice. Just don't expect it to be nearly as fast as it once was.
Yeah, what I look at here is, okay, you had a Bible gap, but you could be playing it that way because it's held so far. A little porosity here 4 days ago, but notice how you're holding very tight just under the 800 level, and volume is drying up. Now, those of you who are familiar with Livermore's century mark rule in reverse, which I talk about in the new book on shorting that was published last April, if it fails, a stock will either move up through the century mark, in this case 800 level, and start running up, or it could, if it fails, then it could turn into a short sale. We've seen this occur in other situations. I think the last time Google got close to 800, that's what happened, and it came off. So if you see it start to roll over, and the volume picks up, and it peels away from the 800 level on the downside, then I think you've got some problems here. And it's also a sign that you have another leading big stock leader starting to roll over and indicating that the general market is probably in for some some trouble. So, I think there are concrete ways to monitor things and to understand what's going on in terms of the individual stocks and operating on that basis. So I find that the biggest moves occur, well, just real quickly also with Amazon. Amazon acts pretty well. So to me, if it failed through the 20-day on volume, that would be a problem. The 50-day even worse. So it's hanging in there, not really going anywhere after earnings. You had the pocket pivot ahead of earnings, and then it gapped up and sort of stalled out, and now it's kind of rolling back. This is another somewhat slow-moving stock. The biggest moves tend to come after earnings, and that's what has happened the last 1, 2, 3, and then it sometimes it just doesn't go anywhere. It rolls back in, or it just edges higher slightly. And percentage-wise, it's not all that much to get excited about. But that's what it does. And what I'm looking at here is if you saw this thing break, I think it's viable probably on the pullbacks into the 10-day line or the 20-day line as long as they're coherent. But if it were to bust and push you out, then you might be telling you that you've got some issues with the general market. So see, those are the concrete signs I want to see before I'm ready to necessarily run for the hills or stop looking at the long side of the market as viable, at least for some swing trades. And that's mostly what I think has been out there. There's been a few trending names, but even those can be swing traded. If you look at this, here's NVIDIA running up and it tries to break out on light volume. Then it rolls over, undercuts all these lows, and then catches a 20-day again. So you could be out somewhere in here and then back in here, and it's just rolling higher. But you could just be sitting on it as well. And at this point, I guess it violated the 10-day here. So, Dr. K, would you be using the 10-day line or the 50-day line here as your selling guide?
Well, for the 7-week rule, right now it's it did violate the 10-day on the 25th of June. So now we're into like 1, 2, 3, 4, 5, 6 weeks. So right now, I would still, if it goes a 7th week, then you switch to the 10-day as your selling that. So right now, because it did violate, how many weeks? The first time it was basically at the end of 6 weeks, it violated the 10-day. So you would just maintain using the 50-day as your selling guide. But again, this is contextual to the way the markets are today. Obviously, if you start to see the market really start to come off hard, you might want to take some profits. Because that rule about taking profits in context with this chart still holds. So, for instance, with this stock, when it had that Bible gap up on strong earnings in May, and then it went straight up more or less, and then it did a sideways. There would be nothing wrong with taking some profits there, assuming that it's going to have some sort of corrective formation. And then when the markets got really weak with Brexit, what was interesting is that this stock held tight relative to other stocks. Yes, it did have a gap lower on volume, but it stabilized, closing mid-bar the second day. So that was a sign that this company is truly a leader in space on a price basis as well. And then since then, it's just gone higher. So, it's a true winner in this kind of market environment. And I would be right now, in other words, this could go a bit longer because it's exhibiting all the leadership characters you want to see. So I would use the 50-day at this juncture. But if it goes one more week, then go ahead and use the 10-day because I do like the 7-week rule. It tends to work in virtually all market environments that I've explored, including this manipulated one.
Yeah, and it's also up over 40% from where it went on as a viable gap up. So you got a pretty decent profit there. And if you bought some here and you still have it, the 50-day would be a reasonable sort of last stand selling guide for the stock. You give up a good, 15% of that move or more if that happened. But, you've got some cushion here. Earnings come out next week, though. So let's see, no real stock questions yet.
Also, I wanted to say, keep in mind that, visually speaking, it's easy to look at this and say, well, the 50-day is all the way down at $50. But obviously, in practice, stocks don't just go straight to the 50-day. It takes a number of days,
Right.
several days or more. And meanwhile, the 50 days moving higher, catching up with the price. So if it did violate the 50-day, you might actually only be sacrificing, say 10% or 12% from where it's currently trading.
Let's see, another one that's been trending pretty well has been Weibo, but you can also see here that this one will run up from the breakout, let's see, 20, 15, 20, 25, 30%, and then it'll form a base. So if it gets extended, you could sell into that and then look to be buying back on a pullback to the 20-day moving average, something like that. Let's see here. But that's been trending pretty well. But notice now it's getting a little bit obvious. You've been moving up, basing, moving higher, basing, moving higher. They come out with earnings next week. So I don't know if you bought it down here around, I think when we first put it on around 18, 19, 20, it's up pretty good for you. It's almost a double, not quite. Maybe what would you say, 90% there up? That's not too bad in this market. FN, well, I think FN is a stock. Someone's asking, could the recent action be considered an undercut and rally? Not really, because number one, you haven't rallied back above the lows of the undercut. So, again, this is kind of like the one thing I worry about when I talk about stuff like this is that suddenly everybody wants to think that every time a stock undercuts some level of support, that it's or some low in the pattern, that it's an automatic buy, and that's not necessarily the case. It's very contextual. So first of all, if we look at this, you have this big volume breakout here, okay? So you got a big breakout, and then here's the breakout fails right here. You got heavy volume. Okay, now admittedly that was due allegedly to a sympathy move to Infinera, I guess, which is another telecom stock that got hammered after earnings. And so you've broken down on heavy volume, and you've undercut this low and these lows and this low, but you're sort of just wedging up into the 50-day line. So I don't really see anything driving this thing significantly higher, or that I just want to jump in and buy it because it's undercut some lows. You really want to see it turn relatively quickly, and that's where you get the undercut and rally sort of fake out, rather than everything that undercuts a low is a buy point. So I think it gets a little bit silly when people start trying to apply something to everything they see that even looks remotely similar. I remember it was like when Bill O'Neill first talked about the ascending base, and my institutional salespeople would be coming into my office all the time showing me charts. Look, here's an ascending base, here's an ascending base. But everybody forgets one major thing about an ascending base is that it forms during a market correction. While uptrends all over the place in the general market are all ascending bases, if you want to push it that far, but it's like everybody's seeing an ascending base everywhere they look. Now I talk about this undercut and rally, which is really a Wyckoff spring, or like Livermore shakeout +3 type of situation. And now every time they see something undercut a low, they want to come in and buy it. But if that's the case, and you think, okay, this is an undercut and rally of this low, so you figure out what's that low, and if it gets above it, then you would buy it as soon as it goes above that low, and then that would be your stop. So you're basically out even roughly if it doesn't work. Now you're rallying into the 50-day. To me, this looks like what, everybody? Who can identify this pattern without mindlessly getting into this idea that, oh, it's undercut a low, so we got to buy it? What other kind of pattern is this? Anybody, somebody says to me, FN to me looks more like a potential short at the 50-day moving average. Yeah, it's actually a late-stage failed base. So you're close with the head and shoulders, but let me see if it is a head and shoulder. Well, I guess no, not really. It's a late-stage failed base, and notice how the base is kind of narrow, short, and sloppy, and it's had a big run. So on the weekly chart, this looks vulnerable to rolling over from here, and it looks more like a short. To me, the only problem with it is it trades 430,000 shares a day, so it's not something I'm really interested in messing with on the short side, because I can start running it one way or the other. But that's while the undercut, and remember, the undercut and rally concept comes from short selling. So what I would do is, if I'm short selling and it undercuts a low, I'll cover and then look to re-enter on the short side on the ensuing bounce. In this market, you've seen some unfold as white coffee and springs, and they undercut and they turn higher, but that's because the general market turns and goes higher. So if you start seeing undercuts that start to rally at the time that the market's making a major low, like it did in the end of January, and notice the market was also back in the end of June, rather, it was undercutting these lows and then it turned. As soon as it starts to turn, you can start looking at all these undercut and rally names like Tesla at the time, but that was undercutting a major low as well. And I'm looking for major lows and patterns, not a low that happened 3 days ago. So when it undercut this low and the 195 low back from August, I think, of last year, which would have been, right here. Yeah, so when it undercut that, that set up the undercut and rally, and as soon as it got back above 195, you just buy it and you start riding it. Now it's pulling in. Now they came out with earnings yesterday, and the loss was bigger than expected. They're basically, I don't know, they're losing more and more money, but it's hasn't killed the stock yet. It's down 76 whopping cents as I speak right now, and I'm not sure. Dr. K, would you go long this, or would you short it, or would you just leave it alone?
Well, with where it's at right now, I wouldn't take action. It's sitting on explosive support. I don't like how it gapped down in June, so I wouldn't be going long this thing. Now I'd be waiting for a better setup. And I don't think, that said, I don't see myself actually getting excited going long this thing for a while. It's got a problem.
Yeah, me neither, actually. If anything, it's good for a trade, and that's kind of what it's been. Every time it's come down to the 20-day line, it's been good for a trade, but that's about it. And it's edged higher, but it's...
short...
Pardon me?
Vehicle. It's a short-term vehicle at best.
Yeah.
I don't, being a long... Its heyday is over as well. I mean, it had a beautiful run, which we nailed in 2013. In fact, we wrote a piece on it. But the problem is that... where it stands now, I mean, yeah, it does have room to grow, and Elon Musk certainly is quite has the innovative mind. So I wouldn't write this off completely. I mean, it could have another run to the upside, but this basing pattern needs to really shore itself up before I would get interested on the long side.
Yeah. Yeah, and you can see it's really gone nowhere for the last 2.5 years, roughly. So you can see that it's just going nowhere, big choppy pattern. So eventually, to me, this looks like a big rolling top, but I guess we'll find out. Let's see, other questions. Someone's asking about data. Data's a good short candidate. Yeah, you had the gap down yesterday after earnings, and now, let's see, this thing's been rallying. So you can see how it's been in this sort of bear flag, and the flag just drifting higher. But it's still a bear flag or a pennant. I guess pennants can flap a little more in the wind than a flag. I don't know, but it's like a pennant, and it could be failing here. So yeah, it's right up at the 50. That's a possibility, as long as nobody comes in and buys them out. That's the only thing that I'm afraid of shorting cloud stocks like this. So, but that's one that could be. Someone says, or is asking about Twilio. Now here's, okay, I know everybody sees the undercut here. So here's an undercut, and it's rallying. So, again, if you were going, in the context of a base formation, sometimes this can work. It'll undercut the low, and it turns higher. And you're getting a trade out of this. There's no volume on it, though, so I'd be a little bit wary with earnings coming out, I think, next week. I think it's the 11th. But that would have been good for a trade. So if as a swing trader, I have no problem playing that. I wouldn't say the stock is broken down. It's just basing. So, see, in that context, it looks a little bit better. Someone else thinks Skyworks is basing. It depends on what you call a base. To me, this just looks like it's forming a second head and shoulders formation. If you look at this, let's kind of blow this up. You can see the top from last July. That's when it broke down. It was a great short going into August. But if you look at this, this is not a base. This is still in a big downtrend. Okay, so I don't know where you get an idea that it looks like it's in a good base, but it doesn't look that way to me. And basically, you had a head and shoulders, and then it broke down. This would have been the late neckline. I'd be getting short. You can see the tiny little head and shoulders up here that makes up the head. I'd be getting shorted in here rather than down here. But it did get a break to the downside, and now it's started to just roll back and forth. But if you look at the pattern, it's actually a another fractal head and shoulders. So, and that's forming, you got a neckline here. This could break down. So I don't really understand why anybody would want to buy it, or why you'd be thinking that this is a constructive base, because it's really not. If you look at this, you got heavy volume here on this reversal off the 200-day line. So it's a short at the 200-day 40-week line here on the weekly chart. And volume was heavy. And now it looks like it's just setting up to roll over. That's what it looks like to me. So I don't really see, unfortunately, I don't really see the bullish formation here. Return on equity 36%, and of course you're the only person who knows that, right? So to me, fundamental data is great, but everybody knows it. So if the pattern's not confirming the fundamentals, in my view, then there's no reason to play. I don't think that the fundamentals necessarily override a crappy pattern, because the market is telling you something is wrong, and thinking that everything's right even though the pattern is weak just because there's a high ROE or something doesn't really cut it for me. So
yeah, I wanted to say that's why it always mystified me why you get these guys who are just pure technicians or pure fundamentalists. Why not stack the odds in your favor by being both? And the reason I found out, I learned later in working with O'Neill, is that people's minds are geared one way or the other most of the time. There's very few hybrids out there. It's just like there's very few people who are ambidextrous. You're either left-handed or right-handed. And fundamental analysis takes one type of mental strength, and technical analysis takes a completely different set of mental strengths. So O'Neill's one of those guys who could do both. I prefer to do both, which is why I gravitated so fast to his the book when I read his book in 1989. How to Make Money in Stocks. It made perfect logical sense, to stack the odds in your favor. And I really enjoy, actually sizing up the company. We got a question from one of the members about, what are we looking for fundamentally? And I think the most important thing is the story behind the company. Is it the leader, or does it have a shot at being the leader in its space? That certainly has guided my investment decisions, and some of the most winning investment decisions over the years. And when you get a whole confluence of great names like in the late 90s, then you have to be able to figure out the Amazons from or the eBays from the UBIDs, for instance, to be able to sift out the true market leaders. And that, of course, keeps it interesting for us and highly profitable. The thing that was interesting is that we had the Pokemon Go company, VoSI. And it was a bit sensationalized. And the thing is that, yeah, it was getting some tailwind from the excitement of Pokemon Go, but at the end of the day, they're not the inventors of the technology. They're not the driving force behind the AR. That driving force is kind of spread out among big companies. So, if there were a company that just dominated AR, I would be all over it. And it'd be like having eBay going IPO back in what was it, 1998. Gil, your mic needs to be on.
Oh, I thought you were. Are you finished? There's
Yeah.
eBay. Whoops. Where's eBay in '98? I was going all the way back.
That was the one, when I read the red herring on it, it was just amazing to see that this is going to be, to me, I knew the space very well prior to eBay that were doing this sort of thing. And I was saying, I practically fell off my chair. I called Bill immediately and I said, this company's going to be huge. And when it was IPO'd, it was IPO'd around, I don't know, $30 a share, I don't remember exactly, but it promptly lost half of its value because the market was in the throes of a major correction. But when it did the U-pattern, it did a U-turn, and then it broke to new highs. That was when I laid into it very hard, and I remember talking to Bill saying, this stock is proving itself. It's done. It's come straight back up to new highs, those companies like that are very exciting to see. And I'd love to see another company like that come along. But the pickings have been very slim.
Somebody's asking Dr. J if you think Square is a viable gap up.
Well, not really, because first you got it gapped lower on its prior earnings report in May, and now it's got an earnings report that is gapping up on, so it's reversing that effect, but it's still it's kind of hasn't really gone anywhere. It hasn't proven itself. It was IPO'd at $9, and there was kind of a rough rule of thumb that that I've used that is stock should prove itself by having at least doubled from its IPO price. And if it's forming this kind of pattern, it doesn't really excite me. To me, if it really is going to go somewhere, it's going to form another sort of basic structure, and then that a sound basic structure, and then maybe it can be playable off that. You know, the sales are good. The earnings is going to stay in the red for a while. You know, and as far as the story behind the company, you know, it's a strong story, but again, it needs to. I don't care how great the fundamentals look. The technicals have to first prove out, and right now it looks a bit premature to get involved with this name.
I would say that I think this is probably a viable gap up, and you saw it pull in. You could use the 620 chart to buy it, but you know, forget about the viable gap up, you guys. Where were you guys a month ago? If you go back a month ago when I was talking about in the webinar, Square, to keep an eye on it down here along the 9 level, and notice it had a pocket pivot about 2.5 weeks ago, coming up to the 50-day. So if you got on board there. And I was saying, go back and look at the webinar. I was talking about this. Look to me like it's bottoming, so you want to look for some signs of a concrete bottom. And just when it was starting to wear me out, you get a pocket pivot. And I know some people bought it, and I don't see anything wrong with buying that there. In this market, those things can work pretty well. And it's up 30% now. Now, if you own it still, and I know you own it, Scotty, you're basically up 30%, and you would have been up, you know, 10, 15 going into earnings, and I didn't really see anything too wrong about holding at least a small position there. But you know, you might be a little bit late here, and I think if anything, you may see it track sideways. But you know, I was seeing this one a long time ago. So by the time you get the viable gap up, it's now a little bit obvious. But there are a lot of people short this stock. One that I like is Fitbit.
You know, this on you know, the whole thing on buying into these ugly duckling patterns and buying, you know, when you get the voodoo pattern setting up is, you know, we've said many times it's a viable strategy in this market, which is more of a swing traders or, you know, it's very shorter term environment, and you can make some quick profits that way. And this pattern certainly shored up, and so now that it's had the viable gap up, you know, the problem, I don't want to say it's a viable gap up, I want to say that it's gapped up. There's more risk in buying it up here, especially given the overall formation, and you know, you could even be using a day like today to take your profits had you been buying it you know, earlier.
I saw the bottom. What can I say? That's where you wanted it. Now it could be a viable gap up. There's definitely a way to treat it like one. And I have no problem buying stocks. Like yesterday I bought Fit, and that was a gap up. You buy it, it sets a low at $13.92, and it trucks 10% higher from there. And it's going higher today, and I still own it. So, you know, I bought another one, Barracuda Networks, and I sold this one too soon. You had a viable gap up here. In this market, and Dr. K, I think you have to look beyond just this sort of cut and dried old way of looking at things. There are a lot of great moves, and they turn into more than just swing trades. I mean, you could treat this like a swing trade, but this thing could be headed a lot higher, this Barracuda. Grub is another one that I bought here at around 34 bucks, and it's up, you know, 10% by the close. And now it's trucking tight sideways. This could go higher, but this is also another sort of bottom fishing type of viable gap up. But in this market, that seems to be what works. You know, it's not the same old stuff. And if you don't have a lot of different quivers in your well, a lot of different arrows rather in your quiver, then I think you're operating with a limited set of criterion with which to buy stocks and make money. You know, unless you find an Nvidia or you find a Weibo, there's not a lot of these that are around. Ulta's probably another good one. Yeah, that one's done. But it's, there's not a lot of excitement. So most of the move occurs on the Bible gap up. So, I mean, I think Square could be treated as a Bible gap up. You could treat it that way. And if it doesn't work, it doesn't work. But I think you can at least take the shot, assuming that you can buy it as close to the intraday low as possible. So that's the trick. You want to limit your risk. So like something with FIT is off and running today. But see, the other thing I'll be looking at here is if they have huge short interest. FIT's got like 38-7%, something like that. Over a third of the float is short. So you got a bunch of shorts scrambling, and they're getting their what squeezed right off of them. And Grub is another one like that. That was very similar. So I mean, and go back and you look at recent recent Bible gap ups in eBay. There's eBay gapping up higher. That could have been bought. Here's Microsoft gapping up higher. That's moved a little bit higher, but it's not like you'd be in trouble if you bought it. So some of them actually, well, I wouldn't say some of them, a lot of them work. And I don't think this is the 1990s where you got to require that they have this, that, and the other thing. Sometimes these things come up out of nowhere and they just start going. And I've seen this happen a lot. FireEye, here's one that'll fake you out. It has a pocket pivot, looks good, just runs in the 200-day line, but maybe it's setting up to go higher. They come out with earnings today after the close. I'd be keeping an eye on this thing. Might have a move, might not. Might be something to keep an eye on. Another one that's announcing earnings today after the close is ATVI, Activision. Yesterday I saw Electronic Arts, and here's a Bible gap up that produced some upside movement, not a huge amount, but it was able to go higher. But again, see how you can buy it here at the 50-day line. But yesterday's a pocket pivot off of the, I guess, coming up through the 10-day line, the 50-day line, whatever. Pick your moving average. And it's holding tight and looks like it wants to go higher to me. So, but yesterday it was down in the morning and then reversed to go higher. But this looks okay to me. It looks like it wants to go higher. So, so I'd watch Activision. I think another cousin stock in the group is Take-Two, and this is kind of one of the cheesier ones, but they come out with earnings today after the close. So it could be a big day for these video game companies, and I'd be keeping an eye on all of these because there could be something that materializes. I would say in this market you even have to watch, I mean, as I showed you guys from last week, the Mobileye sell-off after earnings, and they announced that they're discontinuing their partnership with Tesla. And if you listen to what the CEO said, it's mostly because they think Tesla is cheesy because they take Mobileye's technology and try to pass it off as autopilot when Mobileye considers it to be assisted driving. But you can see how, if you saw the undercut here, you could come in on the 620 and buy it, and that's exactly what I did. And the thing jacked 10% higher from there, and that's, it'd take you days to get a standard breakout in this market to do the same thing. So. But that occurs after earnings. Now you look at yesterday's Zendesk, which is a name that I think we've liked. Had the same thing. It undercuts this low here in the prior base, and comes down on top of this prior structure here. I don't. Can you guys see that? Okay, maybe I could go back to these charts. They're a little bigger. Maybe you can see them better. But you can see how this thing undercuts. The low here, whoops, I'm sorry, the low up here, okay, and then it rallies off the 50-day line here, finds some support along the top of this structure, and then turns. If you're watching the 50-day, the 620 chart, when the stock is around the 50-day, you would have noticed a turn almost 10 minutes after the opening, and the stock turn, and on that basis, sometimes I think you can buy these because you get these fake outs. Same thing happened to EA. Electronic Arts, so it's and then if you buy it there, okay, now you own it, maybe it's got further upside, it's hanging along the top of this base, so it's holding the top of the base, so as long as it holds the 28 level, it's still holding this breakout. Okay, now in this case you got a much better entry thanks to a pullback on earnings. The stock's drifting in right now, 28.19 bid, 21 offered. And it's hanging there. So maybe this is viable. What's the volume rate? What's the volume rate on this one, Dr. K, right now?
Then we've got 36%.
So minus 36% or above? Above. So it's getting hit with sellers and buyers are knocking it around here at the top of the base. See who wins. So I'd watch the volume on this today and see where it goes from here. So, but see, that's the type of opportunity, like with Mobileye, that occurs when a stock sells off after earnings. So, and I think you even saw this morning, if you're watching Tesla, you know, I think Tesla's a trader, as we were saying. But if you look at this morning, it sat there. I know it was bidding up 226. I'm watching it this morning in pre-open trade and thinking, I wonder what this guy's going to do today after earnings. And it's just sitting there, which is odd for Tesla. Usually has a nice move one way or the other after earnings. But it was able to just sit there, and then they sold it off early this morning. I think it got down to a low of, what, 222, I think, and change. Yeah, you can see it on the 620. But immediately it gets oversold right at the opening, and then it turns right back to the upside. Now maybe this thing's going to turn higher, and there's still about 28, 29 million shares of stock sold short in this turkey. And if these guys don't get any love soon, they could be scrambling to cover and maybe drive it to 240. So those are things to watch out for and opportunities that might show up. So, you know, you got BABA is interesting. There's a little pocket pivot here, but this is kind of a ugly duckling pattern. Let's look at this on the weekly chart. You see, this is kind of ugly duckliness, but it's in a low base. You know, this is a cup with handle. You have a 30% prior uptrend, so it's looking a little bit better, but it could also just be a big topping formation. Earnings come out next week, and it's going to roll over. But in the short term, it has been tradable. You can see on the break, here's where it undercut the low along with the market. So when it does that and it gaps back to the upside, and this is all occurring at the same time as the market, this undercut in here, if you go back and look at the market, same time, same bat time, same bat channel, all undercutting a prior low, and it turned and did this with the market. When this occurs in the context of the market doing a similar thing, it has a lot more upside power. And then you can just take a smaller position and let the juice work for you. You know, so you start getting a nice jack off the lows. So that way you don't have too much risk if you have to turn around, cut and run if it doesn't work. So, but I love these sorts of setups. So I make sure I know what's happening every day in terms of companies that are announcing earnings. So today you got ATVI, which is one stock I've been watching, and I've actually been playing it long and short actually as it moves around. But that's been one. I like Mobileye. I think it has potential, and as long as it's in the base, if it breaks out and the market fails, and watch out, it could be a problem. But it's trying to hang in there. I do sort of think it needs to just kind of drift back in towards the 44 level and a little second Wyckoffean sort of retest. You know, this saw volume picking up 4 days ago, and it was above average, and that kind of dries up here. But you're not really getting any thrust out of here right now, so that could be something that needs more time if it's going to go higher. But by the same token, that's what it looks like on a weekly chart, and it could roll over and fail. And so if you start to see something like that, then it's telling you the market may be in for a little bit of trouble. I'm watching Facebook moving higher, so that's actually doing pretty well. But that was viable on the pullback to the 10-day line. Now we'll just see what it does. My guess is it just chops around in here for a little bit, and if the market can catch its feet here and turn higher, and what I'd like to see personally is the Russell 2000. So you look at the rut over here. It's sort of lagging. I'd like to see it break out and start moving. I'd like to see the, let's go down here. I'd like to see the NYSE composite do the same thing. But if you look at these, they broke down on Tuesday, and now they're kind of moving up. What's volume looking like right now in the market? Let's see. It's like a running lower. So you're kind of wedging back up into the lows of this structure in here.
What gauge do you use to track volume, intraday volume?
What's that?
What gauge do you use to track intraday volume?
On the indexes, I just use the investors.com website.
Yeah, too. It's I don't know. It's been a little bit swirly sometimes. I mean, right now it shows the slightly.
Yeah, they've been wrong a few times, and it's a little bit screwy. So you know, they're not that reliable anymore. But you know, I hate to say it, but I think that place is going down the tubes. Bill O'Neill's not there. I think a lot of the people who run the place are somewhat goofball-like. and it's just going to fall of its own weight eventually. But in the meantime, I do look at that site to watch the volume, but it has been screwy. Like, it'll be a weird number, and then it'll suddenly change to a normal number. Anybody else noticing that? Anyways, let me go through some more questions here. Sino, sure. This is a breakout that's failing. These guys come out with earnings. So I don't know if I'd be buying it. It's sitting at the 20-day. I guess if you want to try and buy it, you know where your stop is, and it's pretty tight. They came out with earnings. They actually have earnings.
Or, let's see, October 25th. Yeah, they're coming October 25th.
Yeah. Avago, someone's asking, would you consider Avago yesterday's supporting action? My supportometer says, well, I would call it voodoo action. It pulled down to the 20-day line. Volume is not heavy. So volume is drawing up at the 20-day, but I'd be buying it at the 20-day. I wouldn't be buying it up here. So you got to watch these things when they happen. And but I think in this case, was it supporting action? No, because the volume didn't pick up. It was more like the volume drawing up on a pullback, and it held the 20-day line. So, but you know, it's just a label anyways. Square dancing at the Wyckoff Spring. I like it. Scotty, you're so colorful with your language. Any color on stocks that violently violate moving averages but recapture during the day and flash pocket pivots? Well, I think I was already talking about something like this. If you watch them break, if you see a stock that you've liked and maybe you understand the story and it's breaking on earnings, is that what happened here? These guys come out with earnings yesterday?
Yeah, that's right. They came out earnings yesterday, and they broke down, closed strong.
Yeah, so this is what I was just talking about. You know, you have a stock, and I just used Mobileye as an example. And my response would be, pay closer attention, please. But maybe that question was asked before I talked about it. But again, you know, you go back to yesterday, and you see the thing bust hard, and then you get a 620 sell signal coming back the other way. Now, if you owned it going into earnings, well, you know, you're playing earnings roulette, and that's that. So, but if you didn't, and I would rather not be owning something like this and then looking and maybe entering on the long side when the thing pulls back. So that puts you in a better position. If it gaps up, then you can look at buying the gap up. But, you know, again, if you're watching these break in earnings, and if it's a stock that I've been watching and I played on the long side, like Mobileye was one, Electronic Arts is another one, then I'll be looking at the 620 chart in the day at the opening and seeing what might be issuing as a potential buy signal. So Square's acting pretty well. Baba's coming up. I'm noticing Facebook's still cruising. Maybe I'm wrong. Maybe it's going to go back to 130. I better buy back my position. Oh, GoDaddy. One thing I don't like about this one, it's a big gap up move. You could call it a pocket pivot coming up to the 50-day line, but it's coming after a downtrend, so you got overhead supply here. It's not in the clear. See, I like, if I'm looking at a gap up move, I like them to at least be clearing some sort of a range. If you get that, then I think they have a better shot at working because there's no overhead resistance. Does that make sense? Anyways, let's see here. Tokyo is the new largest shareholder for U.S. equities. Nice. Probably. It's like, what else is there to buy? Maybe that's what's been happening with everybody going to negative interest rates. The only place everybody in the world has to put their money is in U.S. stocks. That's a possibility. Here's Jack. I like Jack. It could be a viable gap up. Sure, why not? And this is what it looks like on the pattern. This could turn out to be a big pod formation that's going to fail, however. But again, if you just want to play it purely on the basis of being a potential viable gap up, then there you go. I'm going to check something here. It's 9 o'clock. I think it's time for us to finish up here. Yeah, notice how grub is drying out pretty sharply here. This one's going to turn. I just bought a little bit of it. See what happens here. Now the thing with Square that I like as well, and which, you know, I think if you have 1129 low here, then that's your stop. I don't really see how you've got a lot of risk because that's half a point down. If you take a position that's smaller, and if it does get going, because there's a big short position in this thing, then I think you could see it continue higher. So, you know, if we let's look at this on a 620, not Jack and nuts, but that one's actionable too. You'd use the intraday low. What's the intraday low here? Whoops, what is that? $95. So that's kind of within range. You know, a couple of percent higher, so that would work. So let's go back to square one. As long as everybody's into square puns, I'm seeing square dancing, square up. You can see here you're getting a 620 turn, so this might be the place to come in. That's a possibility. You made the low, and now you're trying to turn, and I can't tell. Yeah, that could be feasible. Let's go. I'm going to answer the last couple of questions, then we're wrapping it up. Cephate, not this one again. I don't know. This is at the top of the range. This thing has been such a dog. A dog with promise, but no real anything else. But I wouldn't call this a cup with handle breakout. I call this a doggy range here. I don't know. I'm skeptical here. Seems a little bit questionable at best. Let's see. Last question. No, there are no more.
You got with these charts, when you've got these you know, serious corrections, when the defects in the chart pattern, you should go back to that day and find out what caused it to get a better sense of the bigger picture of the stock. And if that couldn't happen again, because there's that saying, you know, when one shoe falls, usually the other shoe falls later, and that has caused obviously some ruptures in accounts if they put too much of their weight in the stock that then gap down overnight.
All right, we do have the jobs number tomorrow, right? Yeah, so we'll see what shakes out as a result of that. But
More the same.
I think it's just a matter of watching the stocks, and as long as you don't see the things that I was talking about, then I think you're okay. You know, and you can try and buy things on pullbacks and see where you get. And I think some of you guys have had some good ideas. So. Yeah, so no more questions. So on that note, you guys, thanks for showing up. Hope this was helpful, and we'll talk to you next week. Take care.
So long, everyone.